Welcome to AM Best Audio.
I'm John Weber for AM Best TV, and I'm speaking today with Professor Justin Sydnor, Department Chair of Risk and Insurance at the Wisconsin School of Business, University of Wisconsin-Madison. Professor Sydnor is co-author, along with Daniel Bauer and Joan Schmidt, of a recent study titled The Economics of Emerging Insurance Technologies: Theory and Early Evidence. The paper explores how advances in artificial intelligence, data analytics, and automation are reshaping the insurance landscape, changing how insurers assess risk, design products, and interact with customers. Professor, thank you so much for taking the time to speak with us today.
Thanks for having me.
So, Professor Sydnor, what motivated you to pursue this project on emerging insurance technologies?
Well, we at the time were editors of the Journal of Risk and Insurance, which is the leading academic journal in risk and insurance. And what we were doing at the time is we had a special call out for theoretical and empirical papers looking at this topic of AI and emerging technologies in insurance. And what we did is we wrote this piece as sort of an overview piece to try to add some additional economic grounding. And part of the motivation here is what we were realizing is that there's a lot of effort on trying to think about exactly how you predict risk, but maybe not enough thought yet about exactly what the value of doing that is.
Now, in the paper, you mention early evidence about how new insurance products or processes are changing firm behavior in markets. What are the biggest empirical challenges that you faced in trying to measure these effects?
Sure. Really measuring what's going on in the insurance industry is especially challenging because there just isn't great publicly available data. So we're forced generally as academics to spend a lot of time anecdotally listening to what companies are doing, inferring some things from consultant reports and annual statements. We're able to get an overall picture of the types of things firms are doing, but it's very hard to get individual firm by firm data. It's just not publicly available.
Now, one dimension of the paper's call is how behavioral factors affect transitions to digital insurance. From your point of view, Professor, which behavioral frictions are most underappreciated in this space?
Yeah. Well, I think, a big piece of what people don't fully appreciate is the small barriers to action that, we sort of think that we can set up large systems or incentives and that people will understand them and respond. But what we actually observe is that, people don't switch insurance companies and shop regularly because the act of having to call up and search online, that small friction is actually a big barrier to change. We also see a lot of this with, the emergence of things like telematics in auto insurance. Almost every company offers that sort of technology, but often what we see is that the big barrier to having it make a difference and be utilized is the small last step of finishing setting up the app, downloading and incorporating those last little pieces of what people are going to do. And so, I would say in general in the insurance industry, there's probably not been enough investment in those kind of what we would call last mile consumer problems.
Interesting. Now, if technology-intensive insurers attract lower risk types, what are the competitive and regulatory implications for more traditional insurers?
Yes. Well, clearly there's always going to be this dynamic that on a firm by firm basis, if some firms can predictably attract lower risks, it's going to raise costs and worsen the risk pool for other insurers and laggards. And this is generally a force that we think is driving a lot of the current investment in technology. Basically, you can't be the last mover in this space. You can't sort of fall far behind. But from a sort of societal and regulatory perspective, one of the things we really focus on in this piece is that the overall benefits to customers and society come from when these investments are not about trying to cherry pick the best risks, but come from some other more fundamental improvement in the ability to mitigate or avoid or cover risk. And that's something that we're seeing less of investment on right now. Right now, most of the investment is, in ways of trying to lower costs a little bit at the margin or identify risk a little bit better than the competitors. But with everyone trying to do that, the end result is a lot of investment in technology, but maybe not a large improvement in the industry.
Customize your data experience. BestLink now offers an interactive company dashboard that provides company-level intelligence in a fast, user-friendly interface featuring interactive tables, charts, and Sparkline performance histories. Customize the dashboard tiles to prioritize the insurer ratings, data, and analytics that best support your workflow. AM Best. Our insight, your advantage.
Now, much of your theory discusses equilibrium outcomes, but as you well know, Professor, real markets evolve over time, right?
Yep.
So how important do you think path dependence and first mover effects will be in shaping which insurers adopt technology first strategies?
Yeah. Well, I think they're really important in that, one of the things we see in a lot of the big areas, for instance, of personal lines insurance are that, there really is very limited customer switching and moving around. There's huge investments in advertising and other things trying to get everyone on the margin, but very few customers are really moving. Market shares are stable. And we can see, if you look at the way that prices vary as people shop for home insurance, if you engage in shopping, you may find $1,000 swings in your home insurance prices. The existence of those sort of pricing differentials tells us actually that it's hard for the market to converge very quickly to a single equilibrium. What we think is kind of most interesting in this space with the emergence of technology is really if there is a sort of deep entrepreneurial push towards very new ways of doing things and distributing that create a bigger potential for disruption. So the sorts of things that we identify are things like, if you look at embedded insurance through things like Tesla, right? That's not a large play. Not that many people have Teslas, but among Tesla owners, a fairly large share of them, about 17%, use the Tesla insurance. That's a pretty remarkable market share if you thought about a way of scaling up that type of behavior. In general, though, we think a lot of the investments are going to be slow to move. And so, I think what we're going to see is, being exactly first or exactly best isn't going to matter immediately, but someone's going to potentially come up with a really revolutionary way of doing things and distributing insurance and create a larger disruption. It's just hard to predict who that'll be and when it'll happen.
So looking ahead, Professor, what are the most important open research questions in the economics of emerging insurance technologies?
Yeah. To me, I actually think one of the really most interesting things is the boundary between improving risk predictions and eroding risk protection. So we can see this in places like telematics for driving, or if you start to look at what's going on in the use of climate models and satellite imagery to predict where, for instance, a wildfire or a hurricane event is going to hit. If those technologies get much, much better, so say with a 3 or 6 month lead, we have a really good prediction of which houses this year are going to be hit by a fire or which houses are going to be hit by a hailstorm. That sort of crystal ball for an insurer actually harms the insurance industry and the value proposition of insurance. So, the whole thing works because both the insurer and the individual face a moment of uncertainty, of real risk ahead of time. They don't know for sure who's going to be hit. As we get better at predicting losses, we have to think more about how we structure the timing of where policies are sold and how they're sold so that we don't erode the value protection of insurance. And I think that's something that's not currently being researched and thought about enough in the industry, of exactly how our rapid advances in predicting losses may be eroding our ability to provide valuable risk protection.
Interesting piece of research. Professor, thank you so much for taking the time to speak with us today.
Right. Well, thank you.
That was Professor Justin Sydnor, Department Chair of Risk and Insurance at the Wisconsin School of Business, University of Wisconsin-Madison. And I'm John Weber for AM Best TV.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.